Hello, everyone. This is Matt with the Fundamental Investing Institute. Welcome to this week's Fundamentals Unfiltered. We are recording this on January 6, 2026. And on today's episode, we're going to be reflecting on Warren Buffett's career as he steps down. Officially, he stepped down on January 1st. So we've talked about this a little bit. Last year, of course, Buffett announced that he was stepping down, and he officially did so on January 1st, which is last week. Stepped down from the CEO role. He's remaining chairman, but he also talked about going quiet. So now the reins of Berkshire Hathaway have been handed to Greg Abel, who was in charge of. Abel really came up through the utilities division. But he started to take on, more responsibility. So a lot of question marks about what Berkshire is going to look like in the future. But what I want to do today is start talking about Warren Buffett's career, because like a lot of investors, fundamental investors, I have learned a tremendous amount about investing, studying Warren Buffett's career. He's been very intellectually generous over the years with a lot of his interviews and the shareholder letters and some other articles. He's always talked about wanting to really be remembered as a teacher, and I think he will be first and foremost if you look at everything that he's leaving behind. So at 95, Buffett's stepping down. And when I thought about doing this show, I decided that I'm going to break this down into two parts. So today we're going to do part one, and we're going to talk a lot about his early life and his early career and some of his intellectual influences, kind of segueing into when he took over Berkshire Hathaway in the early 1970s. And then part two, we'll do a reflection on his time at Berkshire Hathaway and building that into, I think today it's the largest non-tech company in terms of market capitalization. So it's an amazing feat, especially given that Buffett's always thought about himself first and foremost as a securities analyst, what he and his late partner Charlie Munger have built. So with that, Warren Buffett was born in 1930, August 1930, in Omaha, Nebraska, and that's where he spent the majority of his life. And he showed a very early aptitude for numbers and for business. He had a lot of entrepreneurial ventures even as a kid. And by his teens, he actually had several small businesses. And one of them is he had a very successful paper route, and he was making on his paper route, even in his mid-teens, I think by today's standards, he was making probably in the high 30,000s. That is, if you took his income and brought it into today's dollars. So he had other small businesses as well. Now his father, Howard, he was originally an insurance salesman, and then he became a stockbroker, started his own firm. And of course, in Warren Buffett's early life, the Buffett family was plagued by the Depression, as many were, but their situation got better. So his father, Howard, owned this stock brokerage, and that brought a lot of exposure to young Warren. He would spend a lot of time with his father, was always very interested in business. Now, Buffett really did not want to go to college. He thought that he had acquired enough wisdom and learning on his own, and had learned so much about business on his own. He really didn't see the benefit of going to college, but his father really encouraged him to do so. Now, I should say, in addition to Buffett's interest in business and all of his entrepreneurial ventures, he was a voracious learner and a voracious reader. Spent a lot of time. He talks about spending a lot of time at the Omaha Public Library, and he had read probably several hundred books by the time he was in his teenage years. But he did very well in school. He graduated, I think, 16th out of like 350 in his high school. I think in his high school yearbook, he was described as good at math and a future stockbroker. That's what his high school had to say about him. So anyway, at the behest of his father, he applies and is accepted to the Wharton School of Business at the University of Pennsylvania. And Buffett spends a couple of years there, but he really gets homesick, ends up transferring back to Nebraska, finishes his undergraduate at the University of Nebraska. So he gets his Bachelor of Science in Business with a concentration in investment management. And he's only like 19 when he graduates from undergraduate, but he wanted to go to Harvard Business School, figuring that, I'm sure like many people today who go to Harvard Business School, that it would open up a tremendous amount of doors, specifically from the prestige and the social connections. So he interviews with someone about Harvard Business School, but because of his age, he's sort of encouraged to apply again in a couple of years. He didn't want to do that. He wanted to get his education out of the way, so he starts researching other graduate programs, and he starts to look through some of the brochures for Columbia and the Columbia Business School, and he notices through this material that there are two professors at Columbia whose name he had recognized, and those professors were Benjamin Graham and David Dodd. They both taught finance investment type businesses. Now, I want to take a little bit of a detour to talk about Benjamin Graham specifically, a little bit about David Dodd. Benjamin Graham ends up becoming Buffett's really key intellectual influence. And Graham was an investment manager who was an adjunct professor at Columbia Business School. Before that, I think he had taught at the New York Institute of Finance, but he did these lectures. And in 1934, Graham, along with David Dodd, who was originally a teaching assistant for Graham, another professor at Columbia Business School, they took the material that they had from these lectures and put it into a book called Security Analysis. So that book is published in 1934, and that book even today, along with its subsequent editions, is really considered to be the seminal text in investment analysis. What you have to understand is that Graham, of course, is writing this in the midst of the Depression, and stocks are very much out of favor. So the common view is that stocks really couldn't be bought as investment assets. They were just essentially you were gambling if you bought stocks. And that was the view. And of course, the memory of the 29 crash was still very much in the public's mind. And of course, at that point as well, being that you were in the Depression years, very few households had the discretionary income, discretionary wealth to buy stocks anyway. So they're very much out of favor. But what Graham does in 1934 with this book is he argues that what you really want to do when you buy a stock is you want to have an appraisal of what the company is worth. In other words, a stock is just a share of a business. And so if you have an idea of what that business is worth on a conservative basis, you can compare that to the current stock price. And if the stock price was significantly lower than the underlying business value, that could be a very sound investment. And so as obvious as that sounds today, what you have to understand is how revolutionary that was in 1934. So Buffett had read that book, and Graham wrote another book in 1949, right around the time that Buffett was finishing his undergraduate education. And that other book is called The Intelligent Investor. And essentially, it's a lot of the same concepts that Graham and Dodd covered in security analysis, but it's a distillation of these ideas for a general audience. And Buffett reads both Security Analysis and The Intelligent Investor, so he knew a lot about Graham and Dodd, and wanting to study with them. At this point, Buffett didn't really have a systematic way of analyzing stocks. He had read tremendously. He was kind of flirting with technical analysis, which is trying to predict stock prices using charts and so forth. But it was really Graham that gets him to think about a stock as a share of a business. So he goes to Columbia Business School, graduates in 1951 with a Master of Science in Economics. And when he's there, of course, he's taken classes with both Benjamin Graham and David Dodd, who are teaching different courses at the time. But specifically in Graham's course, he was understandably the top student. He had memorized Graham's work, and it was said that when he's sitting in Graham's class, that it was just really a two-way conversation, and all the other students were just kind of onlookers to this. He was that engaged, and of course, he had done a tremendous amount of studying on his own, and he would come to classes with a lot of examples. Graham would do something very interesting, which is he was a brilliant man. He wasn't as interested in money as he could have been, and he would very often give live ideas. So a lot of times people would take this class, and you had a lot of people auditing this class, even from outside the business school, because they were getting live investment ideas. So you would have people sitting through his courses who, during breaks, they would call up their broker and execute trades because Graham was giving them these great ideas. But Graham is very much the father of that idea of value investing, the idea of buying a stock for less than it's worth. And I should say with Graham, if you read security analysis or anything about Graham's methodology, when he valued a business, he was very much focused on the balance sheet. He was very much focused on the assets of the companies that he was looking at, net of liabilities. He had very conservative ways to look at businesses, and this is where Buffett started to differ a little bit from him. So Graham would focus on what are called net nets, and to Graham, this was a proxy for liquidation value. So this is a tremendously conservative way of looking at a company that today you probably couldn't do unless you had very small sums, but you really couldn't do it at scale. A net took the current assets of the company, so things like cash, receivables, and inventory, and would subtract out all liabilities of the company. So he wouldn't even give weight to things like real estate. And this makes sense during the Depression. And you have to realize that even in the 1950s, stocks were, there were plenty of these type of opportunities. I mean, stocks were still selling. Very often stocks were still selling for less than their working capital. So Graham had this very conservative methodology. Buffett broadened that a little bit. And another thing about Graham is that he was purely statistically focused. So he was just looking at the financials. He wasn't paying a lot of attention to what the company did, who their customers were, how they were managed, who their managers were. Buffett started to expand on that a lot in his own investment activities. But when Buffett graduated in 1951, he wanted to work for Graham. Graham had a partnership, an investment partnership called Graham-Newman. It was a very small firm. He actually offered to work for Ben Graham for free. Graham turned him down. The reasoning that's been stated is that at the time, there was a lot of anti-Semitism on Wall Street. Jews were having a hard time finding employment, and so Graham wanted to keep all of his employment options open solely to those of Jewish ethnicity. But again, he had a very small firm. So anyway, Buffett ends up going back to Omaha. And when he goes back to Omaha, he works for his father's stock brokerage business. Now, his father was in Congress at the time. So his father was actually in Washington. Buffett was manning the fort, as it were, in Omaha. But he goes to work as a security salesman for his father. And he does that for a couple of years. But of course, Buffett's interest really isn't in sales. And he recognizes that there are a lot of conflicts of interest in that business. His interest is in securities research, and all that time he kept up communication with Graham. So in 1954, Graham or someone from Graham's firm got a hold of him and said, why don't you come to New York and work as an analyst for Graham-Newman? So he goes to New York, works for Graham-Newman for a couple of years. But in 1956, Ben Graham decides he's going to retire. Graham had a lot of intellectual interests. He was a classicist. He was a mathematician. He was an economist. He was really kind of a polymath. And investment management and analysis was just one interest. And I guess Graham felt that he had made enough. But in any event, 1956, Graham decides he's going to retire, and they're going to wind up the partnership. So at this point, Buffett's only 25, but he doesn't want to go back to security sales, and he decides that he's going to take the plunge and start his own investment partnership. So he goes back to Omaha and sets up this little partnership, literally working from like a spare bedroom. And he scrounges together some money from some family and friends. It's a very small sum, less than $1 million in today's dollars. And he starts managing it. He does very well, and as his reputation grows, he gets more and more investors. He runs that partnership operation from 1956 to 1969, and in 69 he winds it up. We'll talk about that on the next episode, why he winded it up. But from 1956 to 1969, he's running the partnership, and he racks up an unbelievable return. Compound annual gains were about 30%, and that is over that period of time, and that is versus less than 8% for the Dow Jones Industrial Average. So it's this unbelievable rate of return, and if you study the partnership years, Buffett had a somewhat different strategy. Of course, when he goes on to Berkshire Hathaway, which is not an investment operation per se, it's a holding company, but Buffett was known for really investing in these high quality, long-term compounding businesses. But when he's running the partnership and he's investing much smaller sums than he would later invest, he had a very different strategy. So during the partnership years, he described his strategy as kind of falling, described all of his investments as falling into three buckets. He had what he called generals, and these are just generally undervalued companies. So basically, he would look at a company that was selling very cheaply relative to earnings or relative to book value or some other measure of value. This was more of what he learned from Graham, and you would buy these and you would just kind of wait. So it was, buy cheap and wait. If you buy a cheap company, eventually the market, assuming it is cheap and you get the valuation right, eventually the market will catch up to that value or some event will come along. The second, which he did a lot of and continue to do some of this with Berkshire Hathaway as well, is what he called workouts. We might call them today special situations. But these were things like liquidations, and he did a lot of what's called merger arbitrage, something that I've talked about in previous videos. But basically, with a merger arbitrage, you actually invest in companies that are being taken over after the takeover announcement, because from the takeover announcement to the time that it actually closes, there's a lot of uncertainty, and money can be made by investing in that spread. So he was doing a lot of workouts as well. Generally undervalued was the largest component of the partnership for the most part. The third category of investments that he was making back then were control positions. So this is basically where he was able to accumulate at least 50% or more of the voting shares in a company. And in Buffett's early years, he was doing what we would now call some activist investing. He didn't really like the confrontational nature of that, so he didn't do too much of that later. But he did some of that in the early years, where he could buy enough of a company to influence how it was run and influence management. So that was the third category, was these control type investments. So he manages this partnership up until the late 60s. It's also important to note during this time he met who would be the future vice chairman, Charlie Munger. Munger died, passed away a few years ago. But he meets Munger in the 50s, and Munger, at Buffett's suggestion, set up his own partnership. And so they were making a lot of co-investments there before they eventually took over Berkshire Hathaway. So that's really the first phase of Warren Buffett's career. Phase two, which we'll talk about in next week's video, is when he fully takes over Berkshire Hathaway. And Berkshire Hathaway was a textile company, so he makes it into this conglomerate, and he relies very heavily on investments in the insurance industry. We'll talk about why that is. So we'll stop there for part one of this view, of this look on Warren Buffett. But I wanted to talk a little bit about the sources that I used for these videos. And also I want to mention too, we're going to put together a blog series talking about Buffett's career. We'll go into more detail. That will be available on our website, fundamentalinvestinginstitute.com. We'll have the first one out this week, and I'm not sure how many parts that's going to be, but I want to make sure that we're kind of thorough enough, because again, I can't overemphasize how much I've learned about investing and how to analyze companies from studying Warren Buffett. Now, the really good book on Buffett and his partnership years, this is called Warren Buffett's Ground Rules. This came out a couple of years ago, and what it does is it looks at Buffett's partnership letters. So Buffett is very well known for the shareholder letters at Berkshire, but he wrote these wonderful partnership letters when he was running his much smaller investment operation. So this is a book that came out several years ago. I say several years ago, it's probably been more than a decade. And it looks at the partnership letters and provides some commentary and talks about some of the lessons. So anyone who wants to study the Buffett partnership years, this is a great book. Warren Buffett's Ground Rules. The author is Jeremy C. Miller. I think he's actually a money manager himself. But it's a wonderful book, and there's not a lot that's been written on the Buffett's partnership years, but this is a must read. As far as just biographical information, the two best known books, and I'm sure there are other biographies of Buffett, but these are by far the two best. One is Buffett, The Making of an American Capitalist. This is by Roger Lowenstein. This is a book that I first read probably shortly after my undergraduate, and this is a newer edition of the book. But it's great. It talks about Warren Buffett's, early life and the partnership years, and then going into Berkshire. And there's a lot of case studies in this book, but it's general background on Buffett. And then the other book, this came out much more recently. It's called The Snowball: Warren Buffett and the Business of Life. It's by Alice Schroeder. And in this book, there's a lot of first-person interviews with Buffett. So I guess it's slightly more behind the curtain scene. And actually, Buffett elaborates on a lot of anecdotal stories about himself. So I would suggest that both Schroeder's book and Lowenstein's book be read together, because there's enough really complementary material there. So those are the two books that I've used. And again, next week's video, we'll talk about the Berkshire years. That'll probably be a longer video just because there's more to cover. But in today's video, I wanted to just kind of look at Buffett's early years and mention Ben Graham, and anyone who's studying Buffett, just give them some basic background material. Hope you guys tune in to next week's video. Again, check us out on our website, fundamentalinvestinginstitute.com. We'll start to have this blog series going. And have a great week, everyone. And as always, focus on the fundamentals.